Hey guys, welcome back for another Tax Talk Tuesday discussion. About 10 episodes ago, I guess we can call these things episodes, I talked at a very high level about bonus depreciation and then followed that up the next week with a discussion of what's called the Section 179 deduction. Since then, we've actually gotten a few questions, so really appreciate you guys tuning in to watch. But gotten a few questions about bonus depreciation in Section 179, and I wanted to try to tie them together in this video with a little bit more detail. So first, if you're watching this and thinking, I have no idea what any of those words mean, I encourage you to take a few minutes and check out our first two videos on these topics. I don't have the YouTube page in front of me, but probably the only ones on our YouTube page that are talking about Section 179 or bonus depreciation. You're probably also going to see a picture of me, which is scary enough. Happy Halloween. And these videos, they're not too long, and hopefully they are going to introduce bonus depreciation in Section 179 to you in a way that you can understand it. Now, this question, or the questions that we received, come from a statement I made near the end of the Section 179 video, where I mentioned that bonus depreciation and Section 179 aren't linked together under the tax code, and that means that a taxpayer can potentially use both bonus depreciation and Section 179 to save on their year-end tax bill. And quite frankly, a lot of taxpayers do. But that sounds great. How does it actually work? And that's the purpose of this video. Just wanted to dive into a little bit more of the fine print, if you will, and talk about how these two tax provisions work together. So using 2020 numbers, if a business spends less than $3.63 million on qualified equipment, that business is going to be able to expense at least some amount of those equipment purchases under the Internal Revenue Code Section 179. So again, $3.63 million is our upper limit range, where if you've spent less than that, you're going to be able to expense something. If your expenses are less than $2.59 million, you're going to be able to expense the maximum amount that you can under Section 179, which is $1 million, but it's adjusted for inflation, so it's $1,040,000 in 2020. So at any point, any part in the 2.59 million to 3.63 million, that's called our phase out range, and it's a dollar for dollar phase out, where if you land somewhere in the middle, you have to deduct or reduce the amount of your deduction by whatever dollar amount you exceeded 2.59 million. So again, if your expenses are less than 2.59, you're going to be able to take that maximum deduction of $1,040,000 or an amount equal to your net taxable business income, whichever of those is smaller. And this is because Section 179, those expenses cannot push you into a business or operating loss. So looking at an example, let's assume that a contractor purchases $1.5 million worth of equipment, $1.5 million worth of equipment. That's less than the $2.59 million lower limit of the phase-out range, so that contractor could potentially deduct the full $1,040,000. Let's say that contractor, though, had net taxable business income of $800,000 for that tax year. With those facts, that Section 179 deduction is going to be limited to the smaller amount, which is the $800,000. And so basically you can offset that year's income, and that's assuming a whole lot of things, that there's not other deductions, not other income. So just a very siloed example here, but at $1.5 million worth of equipment, $800,000 worth of net taxable business income, the contractor in this example can potentially deduct $800,000 and not pay or not have taxable income for the year. Um, but there's still money left over. There's still $700,000 kind of sitting out there. And that's where bonus depreciation comes in. Bonus depreciation, unlike Section 179, can push you into a business or operating loss because, quite frankly, it is just not limited to your taxable income. So using the same example, contractor, $1.5 million worth of property or new equipment purchases, and $800,000 worth of taxable or net business taxable income. Assuming that the contractor's equipment purchases, they were all of equipment that is new to him, which is a requirement under the Tax Cuts and Jobs Act of 2017, the rest of that, or that total purchase amount, can potentially qualify for bonus depreciation up to 100% of the value of that equipment. Also, thanks to the Tax Cuts and Jobs Act of 2017. So for easy math, we're going to make a whole lot of assumptions, namely that the contractor's purchases qualified for both Section 179 and bonus depreciation, that the contractor did in fact expense the $800,000 to offset their net taxable business income, and that the contractor then utilized bonus depreciation to deduct the full remaining $700,000. That contractor now has a net operating loss, and for easy math, again, we're just going to call it the $700,000. And this is where things get even more interesting under and thanks to the CARES Act that passed earlier this year. Prior to the CARES Act, we had some limits on what we could do with that net operating loss. And I think our very first video in this Tax Talk Tuesday series goes into a lot more detail on that. So tossing back to earlier videos again. But basically, depending on your entity structure with this CARES Act in place, the net operating loss of $700,000 in this case may potentially pass through to the contractor's individual tax return, depending on, again, if it's a pass-through entity, an S-corp. But again, basically, net operating loss can offset other income he may have. So in previous years, the net operating loss deduction could not exceed 80% of the taxable income in any year. The CARES Act has done away with that 80% limit. And so in 2020, for this year, a net operating loss can offset up to 100% of taxable income on a person's individual tax return. So for 2020, you can utilize the changes that were brought on by the CARES Act to potentially eliminate taxable income for the current year. You can now carry unused amounts of that backwards to offset previous year's income. There's some limits on that we talked about in a previous video as well. And you can also carry any remaining unused loss forward to deduct against future income. So this is a valuable tool, using Section 179 and then layering bonus depreciation on top of it. So again, huge opportunities here. There's a lot more to this story, and there's things like depreciation recapture to watch out for, things to definitely talk about with your CPA. But at a very high level, these two tax provisions, Section 179 and bonus depreciation, can result in significant savings. And so if you've made or plan to make any significant equipment purchases in 2020, I highly encourage you to talk to your CPA and discuss what options like bonus depreciation or Section 179 or some combination might be available to you. But as always, that's where I'm going to end it for now. Thanks again for watching. I really hope this does explain in a little bit more detail how these two provisions work together. Also, special thanks to our clients for watching these and asking questions like this so that we know where to focus our attention. So hopefully we're putting out good material for you, so you'll keep clicking on these things and watching them. So if you have specific questions or any ideas that you'd like to see us talk about, just let us know. Until next time, I hope you guys have a great rest of your week. Thanks.